Hey friends, in the video today, I want to discuss the dividend snowball effect and how I am personally using this to reach my financial goals within 6 years. Financial independence, retire early. I'm going to get into my strategy and also some of the stocks and an ETF that I'm buying right now to reach my financial goals of passive income within 6 years. As you can see on the screen, it all starts out with 12%. This is my magic number. I need to compound my dividend income by 12% per year on average over the next 6 years to double my dividend income. I want to double my dividend income because that's what's required to reach my financial goals. This is not a simple calculation, but this is compound annual growth of 12%. The way I'm looking at this is I have a hypothetical number here of just $100 as a baseline to illustrate a point. My real dividend income obviously is very different than $100. But as you can see, I can get that $100 to $197, which is roughly double over the course of 6 years by compounding it each year at 12%. 12% is my magic number. It's really important to stay on track. But 12%, it seems kind of daunting. And so what I want to do is see, Ian, is this even realistic? Well, the first thing I want to do is look at historical precedent. Over on Corner Patreon, which I will link to in the pinned comment below, I share my stock portfolio, percentage allocation to each position, and I update this typically quarterly. I want to share some of that data right now here on YouTube to look at history. How am I growing my dividend income over time right now? As you can see on the screen, I am basically doing about 12% right now. It's actually gone down over time. And so let me explain this. You see a table. In this table, I look at my most recent Patreon update, Corner Patreon update, and look, I am doing another one right now for December. So thank you for your patience, everyone. That one will be out sometime here in December, but let's just look at the October one for now. If I look at October of 2025 and I compare it to previous time periods like December of 24, August of 24, and December of 23, we can see how much has my income gone up over time. Well, over the last 10 months, it's up 10%. Over the last 14 months, it's up 17.2%. Over the last 22 months, my dividend income is up a staggering 39.9%. Now, what I'd look at here, and I think it's important, is in months elapsed, we can compare this kind of on an annual basis. So the first comparison has 10 months elapsed. But if I take that 10 months and I extrapolate it out to 12 months, I'm actually on a run rate right now of about 12% dividend growth over the last year. I need to hold the line, everyone. I'm right at it, 12% right now. I need to hold the line, and I need to do this for 6 years. We'll see. Can I do this? Is this possible? It's going to be really interesting. But as you can see on the screen in front of you right now, let's look at some other comparisons. When I go back in time, over the last 14 months, I've done 17.2%, and annualized, that's about 14.74%, which is above my 12% run rate. So realistically, maybe I'm a little bit better off than 12%. We'll see. Over the last 22 months, I'm up a staggering 39.9%, which kind of extrapolates out to about 21.76% over the last 12 months. But that period, I don't know if it's the best comparison. I had some one-time game changers. I put a lot of capital in some really high yielders like Altria and British American. I did it at the right time. I benefited in a huge way. These are kind of once in an investment career type of opportunities. They're likely one-time events. So I don't know if I can use that comparison. I think it's more fair to say that I'm probably about 12% run rate. I need to hold the line. Maybe I'm a little higher than that in kind of the 13 or 14% range. But realistically, I'm at about 12% right now. And so key takeaways. You can see the numbers are shrinking. Why is that? Larger portfolio. It's harder to achieve cash flow compound annual growth rate over time because net new capital does less as the portfolio gets bigger. I'm going to get into this in a minute when I look at the levers behind my strategy. Before I go on, if you want to see my dividend stock portfolio in a lot more detail with percentage allocation to each of my positions, whole lot of columns, whole lot of data, I have that over on Corner Patreon. I'm going to link to that in the pinned comment below. Also in the pinned comment below, I'm going to link to Blossom Social. On Blossom Social, I share my top 10 positions with percentage allocation to each. I just updated my portfolio there. It's free to get started on Blossom Social. In terms of full disclosure, I'm a Blossom Social affiliate, and it's my affiliate link in the pinned comment below. Let's keep going. As you can see on the screen in front of you right now, I have more ground to cover. So what I want to do next is I want to go through the dividend snowball effect and my strategy. And so there's 3 levers that I'm pointing out here, but there's actually a 4th lever, and the 4th lever is time, but we already discussed time. Time is 6 years, and I don't want to wait longer. And so the strategy that I have, the levers I have in the snowball are dividend growth. I'm a DGI investor, dividend growth investor. The stocks that I invest in and the ETFs typically grow their dividends over time. Well, when I look at my last corner Patreon update, I'm doing about a 5-year CAGR of 4.66%, weighted by dividend contribution percentage portfolio wide. Lever 1, 4.66%. I actually round it down to 4%. So over the next 12 months, let's just look 12 months. Let's not look 6 years. Let's just break it down for 12 months. I think I can grow my dividend income by about 4% by doing nothing. And that is really just relying on the companies that I own to increase their dividends. Now, historically, over the last 5 years, it's been 4.66%, but I'm rounding down to 4% because I am seeing dividend growth slow. Dividend growth for a lot of the high quality companies that I do own right now, it has slowed a bit over the years. And so I'm being a bit more conservative here. But this is probably one of my favorite levers because I do nothing. I just rely on the companies. I rely on the employees at the companies to work hard and increase my dividends over time. In the next video, I'm actually going to get into a few specific stocks in more detail. Don't worry, I'm going to talk about some stocks today as well, but I'm going to go in more of a deep dive to talk about what I'm seeing in the marketplace on a case-by-case basis with dividend growth. So if you do want to see that, please make sure to subscribe to my channel so that you don't miss out on that video. But needless to say, dividend growth, it's kind of slowing. I'm counting on 4%. 4%, well, that's only just a fraction, 1/3 of the way of where I need to get to reach my 12%. So how am I going to come up with this other 8%, everyone? Check it out on the screen right now. Well, thankfully, lever 2, I have dividend reinvestment. And I love this lever as well because I don't have to do anything other than remain disciplined, try to keep my budget low, not rely on my dividends too much. Now, right now, I am using some of my dividends to pay bills, but I'm trying to scale that back to reach my goals. I'm trying to be frugal here. It's hard for me because I am going for a fat fire with my goals, financial independence, retire early. I like to travel. Life is expensive, but I am trying to reinvest more dividends than I have been recently. Anyway, dividend reinvestment, I'm just using my portfolio average right now, yield of 3.6%. Now, I am selectively reinvesting, and so I think I can bump this up higher to about 4% via selective reinvestment, but then I round back down to 3.6% because, yeah, I am pulling some of my dividends to pay bills. And the reason that I do that is I work in real estate and my income can be lumpy over the course of any calendar year. And there are months where income is a little lower than others. And when the income is lower for me, I actually do tap into dividends on some of those months. Anyway, I'm selectively reinvesting into higher yielders to get more out of my dividend reinvestment as I get closer to the finish line. But I round down to my 3.6% portfolio average in this calculation because I know I'm pulling out some of those dividends in certain months to pay bills. Okay, as you can see on the screen, levers 1 and 2, my favorite levers of the dividend snowball, because they really work for themselves. I don't have to do much here other than remain disciplined, and I'm already up to 7.6%. But how do I close this gap? How do I get to 12%? Well, lever 3, net new capital. So I need to grow my dividend income this next 12 months and in perpetuity over the next 6 years by about 4.4% per year by deploying more money. Now, I think I'm going to be fine in year 1 because I've ran all the calculations. I understand how much net new capital it's going to take. And I think I can come up with that net new capital. But here's the deal. Levers 1 and 2, they scale. This is the beauty of the dividend snowball. It scales. Levers 1 and 2. Because the dividends, they're going to keep growing probably, I would say, portfolio-wide by about 4%, maybe even more because recent history is 4.66%. Dividend reinvestment at 3.6%, I see that kind of as a no-brainer for me. Those scale as the portfolio gets bigger. But as the portfolio gets bigger, net new capital doesn't scale. I need more net new capital to close the gap each year. Just to get that 4.4% that I need each year from net new capital, I need to deploy more net new capital each year to get it, because the portfolio is bigger. It doesn't scale. Now, I can get some scale by deploying money into higher yielders and to get more for my money. But the downside of the higher yielders is the dividend growth is slower. And so I get less out of lever 1 if I optimize for lever 3. And so it gets really tricky here. It's a complex formula, but as you can see on the screen, year 1, I think I can hit my 12% no problem. I think as I get into years 2 through 6, it is going to be a little more difficult. And so let's look at some of my concerns here. Reliance on lever 3. Lever 1 is slowing. We know it. I know my dividend growth is slowing. What I'm worried is lever 3 is already hard enough to come up with that kind of net new capital in a mature portfolio, but it will be even more difficult if lever 1 slows. I'm also concerned about inflation. Do I need to grow my dividend income by even more? Is a double enough? What about future inflation? Well, I have some solutions. So solution 1, selective reinvestment on lever 2 into higher current yielders. Solution number 2, deployment of new capital on lever 3 into higher yielders. Solution 3, try to beat this 12%, especially in the first few years, to get that snowball going, because the quicker I can get the snowball going, it will have less reliance on the last few years. Now, there's some wild cards and kind of contingencies in my strategy. I don't want to do this. It's not part of my strategy, but I always like to have a backup plan. In year 6, could I sell some of my lower yielders and redeploy into higher yielders? My portfolio average current yield is only 3.6%. It gives me a lot of flexibility. That low average yield is probably one of my greatest strengths. And so that's something that I can keep in mind as well. Okay, now is really the fun part of the video. I get to go shopping. I have the strategy. I looked at the history. I have some goals. I'm excited about 2026. How am I going to get there? I don't even need to worry about the next 6 years. Let's just worry about the next 12 months. How can I do my 12% dividend income growth? We'll check it out on the screen right now. These are some of the stocks and an ETF that I'm looking at right now. And my corner patrons and my backyard patrons already know about a lot of this because I share my trades over there, and corner Patreon, the portfolio with all the columns. But check it out. It's here on YouTube now. These are the stocks and ETFs. SCHD. It is a starting yield just above my portfolio average, but I like this one because the 5-year CAGR is over 10%. I expect the CAGR to decrease, possibly quite a bit, but it's going to be better than my portfolio average, and it plays a role for that reason, because I need to keep the CAGR up because that's what really scales over time, and it's a lot easier than net new capital. I have Pfizer high on the list because at 6.6% starting yield, it can get me to my goals quicker. It can give me more efficiency on my net new capital deployed. Yes, that net new capital deployed in Pfizer will not have as high of a dividend growth rate because it's only 2.5% per year on average over the last 5 years, but I'm close to the finish line. And a higher yielder like Pfizer can do a lot. I've got General Mills on there at a 5.3% starting dividend yield. Campbell's Company at 5.3% starting dividend yield. I've got Kimberly-Clark at a 4.8% starting dividend yield with a 3.3% CAGR last 5 years on average. Clorox at a 4.7% starting yield, Viatris at a 4.4% starting dividend yield, and basically no CAGR. And I have a bonus stock. I'm going to share that one over on Backyard and Corner Patreon. I actually have already discussed it in a recent blog post, but I'm going to do a full video over there on Corner Patreon on that particular stock when I do buy it. But basically what you see out of this list of stocks and the ETF, I'm really optimizing here mostly for high yield, although with SCHD, it's a combination of portfolio kind of parity yield and the high CAGR. And I'm going to dump as much money into those stocks and ETF as I can, especially in these early years, especially over the next 12 months, because I need to get the snowball going to reach my 6-year goal. And that's where I'm at, everyone. That's my financial independence, retire early journey, looking late 2025 into 2026 and beyond. If you enjoyed the video today, please click the like button. It means the world to me. And I can't wait to see you in the comments below. What does your journey look like? Please put in the comments below. What kind of stocks and ETFs are you looking at right now? This is the end of the year. It's a great time to reflect. I can't wait to see what all of you are doing in your personal lives. All right, everyone. In terms of a full disclosure, I own the stocks and ETF mentioned today. In terms of full disclosure, I'm long Altria, ticker MO, British American, ticker BTI. I'm long the ETF SCHD. I'm also long Clorox, ticker CLX. I am long Kimberly-Clark, ticker KMB. I am long General Mills, GIS. I am long Campbell's Company, CPB. I'm long VTRS, VTRS. And I am long Pfizer, ticker PFE. I own those positions in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey for fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market. In terms of a friendly disclaimer and a full disclosure, I am long Blossom Social, and my link in the pinned comment below is my affiliate link to Blossom Social. It's free to get started, but I get compensated for people to use my link and sign up. And I can't wait to see you in the comments below, everyone. I wish you all an amazing holiday season, and I'll see you all in the comments below and in the next dividend stock investing video.